Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte, Chief Technical Analyst with StickyTrades. And before we get into the charts, I want to first point out to all of our members and soon-to-be members that I use a 7-point trading checklist to analyze the technical signals. And if you'd like a copy of this, I give you full permission to take a screenshot right from this video, or you can do a little bit better and go and set up a free membership with StickyTrades. Just go to StickyTrades.com, set up a member page. It is for free, and then you could download the checklist from there, as well as pick up my midweek reports and weekly market reports on your own member page. Now, if you take a look at what's happening here with consumer debt, we are at record levels on credit card debt, while at the same time, personal savings has dropped to an all-time low. This has never happened before. The divergence between debt and savings is disastrous. As you may know, as interest rates remain higher for longer, interest rates on credit cards is variable. The longer rates stay at the higher levels, the more it costs people to finance their own credit card debt. So what this usually does is it leads to bankruptcies, and we're seeing an uptick in that as well as delinquency payments on automotive loans and even mortgages. I'll get to that next week. Now, at the very end, I'm going to be giving you some added value as I show you how to set up fan lines and use them for entry points, and also how to use them for managing risk. If you take a look at what's happening here, I follow Dow theory. And so Charles Dow, over 100 years ago, developed 6 tenets of Dow theory, with number 4 tenet being that the averages must confirm each other. In other words, if the industrials are going up, to show confirmation of a bull trend that will last, you need the transportation averages to be going up. And we're absolutely not seeing that. In fact, if you go and compare what makes up the Dow Jones Industrial Average to what it looked like 100 years ago, you will see that we rarely have any true industrial stocks in there. You open up the Dow Industrial Average, you'll see a mix and match of stocks that are basically being rotated in and out to make that average look good. But the transportation average, you really can't mess around with too much, because you got the trucking companies, you got the rail companies, you got shipping companies and such. So for me, the transportation average is a much better indicator of what's to come in our economy moving forward. So that is the widest divergence we've had as well. And so something has to give. I believe it's the industrials that'll wind up catching up with the downturn in the transports. I do not believe at all that we're going to have enough strength in the transports to catch up with the industrial average. So if you doubt that, just go and look at any of the trucking companies out there, and you'll see that their loads are getting lighter, their profits are getting smaller, and that too is a leading indicator. And last week we had a couple of people comment on that as to what they're seeing in their own trucking companies. So that to me is a leading indicator. Now, if you want a little bit more information about that and what Dow theory is all about, you can go to Investopedia. I like to refer people to Investopedia because they've really done a good job laying that out in all 6 tenets of Dow theory. But again, the transportation average is closely watched by many analysts because it's used to confirm the state of the U.S. economy. And as you will see, as you move forward in looking at the data, here's one that I talk about all the time, the inverted yield curve. This, again, unprecedented. We've never had a period in time where the yield curve has remained inverted for such a long time. And so this is one of the best, if not the best, leading indicators for a recession. Now, because we're in a presidential election year, the elected representatives absolutely don't want you using the R word, let alone the S word, which is stagflation. They're going to avoid that at all costs. But that's exactly where we are headed. If you have inflation combined with a recession, or worse, a prolonged recession, possibly even a depression. I hate even bringing up the D word there. We won't get shut down on YouTube here. But I'm telling you something, folks. The technicals are still pointing down big on the long term. Now, hold that note, because if you're a member, you'll know we're making money on long positions. But our long positions are very short term in nature. Just take a look at the last trade that we did in Valero. Look at SLV. Look at some of the other ones where we've taken long positions, but we get out, we take our profits very quickly, then we use those profits to pay for longer term bearish strategies. So if you're interested in learning more about how we are maneuvering in this market, just go to Sticky Trades and get your membership all ready to go. All right, now looking at the banking sector, this came out a couple of days ago. Reuters reported U.S. bank failures could surge by almost 50. This is according to Nomura analyst, and this is 50, almost 50. Now watch this. The day before this article came out, CNBC put an article out showing why hundreds of U.S. banks, hundreds plural by the way, hundreds of U.S. banks may be at risk of failure. Now, remember, what's causing these failures? Higher interest rates, right? The regional banks especially have parked their investments in longer-term bonds, so they're locked in at low returns while the interest to borrow money is higher, so they aren't able to make the requirements to loan money out. And if they can't loan money, which is their bread and butter, they go under. As I've said many times before, I'll say it again and again, I believe this is a concerted effort by the big banks, the banks that are too big to fail, as well as the global banks, to more or less eliminate the regional banks so they could gobble up their assets and put them on sale for pennies on the dollar. You watch what happens when the regional banks start to collapse. You're going to see FDIC move in. The government will come in to protect depositors, and giving these bigger banks the opportunity to take over their competition and build out through acquisition. So this is something that is happening in real time. Keep an eye on that, as well as the BRICS nations. Many have reported that in October, the BRICS nations will officially announce they're delinking the US dollar from all trade. Now, you have to understand, the BRICS nations are now responsible for just about 50% of all the oil output, and their combined GDP represents about 40% of the world's GDP. So they become superpower as a group, and the U.S. is ignoring it. The dollar is going to implode. You're going to see the fallout from that eventually, and then what's going to happen is you're going to see the BRICS nation introduce their digital currency. Now, I don't have a chart here showing what's happening in China and how they're gobbling up all the gold reserves, but go and do your research. Don't take my word for that. Go out and do your own research. They are buying up gold to secure their digital dollar or digital yuan, and they will have a currency that's pegged to something of value so that they can't overinflate it. They can't create more than what they have in the gold reserves. It's the way it was back in the day when we had the gold standard linked to the dollar. Now, after the BRICS delinks from the dollar, after they've created their own digital currency backed by gold, you have to see what's happening again in real time. The world is moving to digital currency. Here, you have a bank in Australia. As of this month, in fact, 3 days from now, May 20th, they are restricting all customers from depositing cash or checks or even withdrawing cash. So what is that causing? That's causing a run on the Australian banks. In fact, an Australian senator here, Malcolm Roberts, recently posted this one on May 10th, that the Reserve Bank data came in showing that Australians made almost 31 million ATM cash withdrawals, amounting to over 9.5 billion in withdrawals. That's up 3.6% from February in 2023. Now, the fear of not being able to pull out cash from the bank is causing this run on the banks, but this will be, again, a global fallout. Remember what I said about the regional banks. What do they need in their accounts to be able to survive? They need cash. So if depositors turn opposite and start withdrawing their money, then the banks will not have the financial requirements needed to run. They will fail. Just like First Republic this year, they're going to go belly up and the dominoes will start coming down. I don't tell you this to scare you. I tell you this to prepare you. If you take a look at the diamonds, here we go. I'm keeping that downside target of 379.61. Why? We have a full-fledged pivot there. See that as I magnify that? We have a lower high, lower low. Take out your trading checklist. What is that? We have a shooting star, which is bearish, and we have a check mark in the bearish column. Follow along with my trading checklist. I'll announce this one at a time. So again, we have a shooting star right there. That is bearish. We have a pivot. That is bearish. We have a drop in volume on the way up. That is bearish. We have a wide divergence from that 20-period moving average. Bearish. Gap below the market. Bearish. Sell signal on the stochastic. Bearish. And look right there. We are a fraction of a hair away from a sell signal on the CCI. The CCI, by the way, is my favorite oscillating index. What happened the last time we crossed with a bearish sell signal on the CCI? Here and here? Well, guess what? We tanked right after that. I think we're going to see a duplication of this down leg all over again. And that's why I am not moving my target away from the diamonds being at 379.61. Now, that's just on the diamonds. But remember what I said at the beginning with regard to the fourth tenet of Dow theory. I'm going to show you something here. Here's an intraday chart of the industrials. Look what happened throughout the day. We wound up higher with higher lows, higher highs. But look what we see here in the transports. The transports were selling off for most of the day while the industrials were going higher. That's a divergence that does not confirm a sustained upward trend. That's shown as a weakness. Now remember, the transports are comprised of the trucking companies, the rail companies, shipping. The industrials are being manipulated over time and replacing them with companies like United Healthcare and Verizon, which are not true industrial stocks. See, they're replacing that to make the industrials look good, because every time something starts to fail on the industrial side, they'll boot it from the average and put it in something that looks a little bit more bullish that may not have a direct correlation to the growth of our economy. Now, there's going to be a lot of people that debate me on that, but I'm a good old-fashioned Dow theorist, and I follow Dow theory to the letter. Hence the reason why I am not budging on my longer-term downside targets, because I do believe we are on a path to absolute economic destruction. Do not fear that. Embrace it. Understand it. Learn how to trade it and learn how to manage risk within it. And you're going to be able to sleep at night and do very well. I'll show you how to draw those fan lines at the end, so stand by. Now, if we go and look at IWM, which is the small cap ETF, you can see here that we have the same thing. Again, taking out your trading checklist, what do we have? Hanging man, that is bearish. We have a pivot, that is bearish. Gap below the market, bearish. Wide divergence from the moving average, bearish. We had the drop in volume yesterday. That's bearish. We have an official sell signal on the stochastic, an official sell signal on the CCI. Bearish, bearish, bearish all the way down. Downside target 198.95. Again, looking back at history, when was the last time we saw a full-fledged sell signal on the CCI? Right there at the beginning of April. What happened thereafter? Boom, it got punished. And I think, again, we're going to hit that target and not even have a problem. So stand by. You option traders out there especially, we're not selling any puts. Not right now, because we don't want to be selling puts when the markets start to go down. I say we, meaning our members. This is not advice given in any way, shape, or form. If you want that education, again, come to Sticky Trades. I'll show you how to trade options and spread it with the least amount of risk. And then, again, you'll be able to follow the signals with the checklist and be able to trade without being stressed out. Okay, looking at QQQ, here's the tech sector. It's pretty much going to be the same story. Go to my X page. I have a chart of the Qs that have some notes attached to it. Yesterday, we had a bearish candle known as a shooting star that doubled as a bearish harami. A bearish harami is as bearish as a bearish engulfing. We had the drop in volume yesterday on that high. We had the sell signal come across today on the stochastics. We're a hair away from a sell signal on the CCI. So my downside target right there at green dotted line is 425.73. Has not moved at all. SPY, taking a look at the S&P 500 ETF, pretty much the same story. Pivot, shooting star, bearish harami, drop in volume yesterday, sell signal, downside target 501.22. This gap is very interesting, and the reason I'm keeping that target so low is because of the VIX. Take a look what happened with the VIX. We're now down below 12, folks. This has not happened in a while. With the VIX being on the low, you can see that as I zoom in here, there is a gap above the market on the VIX. That will be filled at 1460. I've given a 100% guarantee that that gap will fill because the VIX is an oscillating index. However, the big question is when. When will it fill? It's always the big question I get from people. You never know when, but I can give you a guarantee it will fill. Why? Because every upside gap on the VIX has filled in the history of the VIX. And so my upside target on the VIX is 1838. Remember, for the most part, the VIX is inversely related to the S&P. So if the VIX rallies, what's going to happen to the S&P? It's going to drop. Now, before I get into the fan lines, I just want to show you what's happening here with the dollar. The dollar is in trouble. It's flirting with this trend line. Remember what I said, if the BRICS nations delink the dollar, you're going to see a collapse of the dollar, which is going to start the domino effect in the Forex market. And so with that said, there are people that are getting a little nervous about the dollar, hence the reason why silver and gold have been rallying. Folks, I'm telling you something. I've been long silver for 17 years, accumulating it. I did sell some recently, but I rolled into SVRA. Some of you know that already. Go back and listen to some of my recordings so you could see how I'm pairs trading that. But SLV was up almost $2 today, one of the biggest up moves in SLV in years. And if I back out and look at the monthly chart, let me just tell you, you could take out your calculator using simple math, take the average price of this whole area right here for that 3-year period from 2010 to 2013, then take the average volume. You see that? You can figure out what the average short cost basis is for a lot of these banks. The average short basis is going to be right close to where we are right now. Now, I can't tell you when the short squeeze is going to take place, but I can tell you that the big banks who are short silver are getting very, very nervous. Go listen to Bix Weir on Road to Roota. I'll put a link in the description box below so you could listen to him and how he deciphers the delivery notices from COMEX. COMEX is in big trouble. I was a member of COMEX for 10 years. I know how this works from the inside out. If they don't have the silver to deliver and there's enough people willing to create a squeeze, oh, there's going to be the Mac Daddy of all squeezes. Silver can go from 30 to 50 very, very quickly. So stand by for that. I'll be reporting on silver soon enough. Another one I want to report on, I know I'm giving out a lot of value here, but I want to look at Bitcoin. You see that I have my target on BTC. It is now officially hit my upside target. Go to my X page. You'll see how I've been announcing Bitcoin. I had a downside target on Bitcoin. It hit. I had an upside target from there that hit. Then I raised my upside target on Bitcoin and it is now hit. Now Bitcoin could go a little bit higher, but I think it's going to meet some resistance up here and then start to pull back. I'll put some more charts out on X to give you my forecast on where I think Bitcoin's going to go next week. Just make sure you follow along on my X page and I'll put some charts out with some notes attached. Now let's get into fan lines. Let's take a pretty popular stock, which I would say is popular in the AI space, and that's NVIDIA. Now, I'm going to slow it down just a little bit to show you how fan lines work. If I go back into the history of this stock, you could see that the trend way back here was pretty flat, you see. But in drawing fan lines, you have to start with a base. I'm just going to start right in this area, and you start drawing a fan line from the very first angle of when the trend started. So you could see here, this was a pretty flat trend, just slight. but it was from these lows here connecting to this low here. Now, when drawing fan lines, you have to learn how to connect the dots by taking the last touch in the fan line that you're measuring from, follow me here, and you start the new accelerated trend line. So you take that point, project it out to the next point here, and you drop it. See the acceleration in the trend from fan line number 1 to fan line 2? What happened in 2023? Last year, we started to see an acceleration from that low to that itty-bitty low. I'll magnify that for you right there. See that? So I'm connecting those two lows. There's the accelerated trend line for a couple of months, and then we drop it there. So here's 1, 2, 3 fan lines. What are we doing? Same thing. Repeat and do it over again. Take the last touch, connect to the low. Take the last touch, connect it to the lows. Now, this is a monthly chart, so I have to zoom in a little bit. I'm going to go to the weekly chart to make sure that these are all lined up properly. You see, there's the weekly chart. Low to this low. Now I'm going to zoom in just a little bit, and I'm going to go to the daily chart. Now, this is where it gets really interesting. Take the last touch, connect these lows, and what do you got? You're at a resistance point. Now, I've been measuring fan lines and gaps and all the other good stuff for over 42 years. Here's a statement that no one else will make because they haven't tracked it for so long. When you have such an extreme angle in trend lines like this, also known as fan lines, you have to understand, again, these are all accelerations. Once you get beyond 3 fan lines and the trend is accelerated beyond 3 trend lines like that, then you have a 90% chance of the stock dropping once the most extreme fan line is broken. Where will it drop? Again, 90% chance it will drop to the next fan line in the sequence. Once this fan line breaks, now there's an 80% chance that it'll drop to the next fan line. If that one breaks, there's now a 70% chance it will drop to the next fan line in the sequence. And the percentages drop as you go further and further down the fan. Now, how do you use that? Well, if you're brand new and you don't know how to read a chart, at least learn how to draw a fan line, because if you're long this stock, what are you going to do? You're going to put your stop below the most recent fan line. If you're looking to take a new short position, let's say you were an option trader and you want to buy a cheap put spread on NVIDIA. You don't have to have millions of dollars in your account to do that. You could buy a cheap debit put spread. Just giving you some examples here on how to trade. You got to learn options to do that. Don't just go out there and start buying put spreads because you heard me on the YouTube video. I would say learn how to trade debit put spreads. It's a conservative way to do it. And then you have an entry point. Once that fan line here is broken, you start buying your put spreads until it hits your target fan line in the next fan line in the sequence. Then you get out, take your profits, move on to the next stock, and draw your fan lines all over again. Folks, we have a lot of content at Sticky Trades. We put together Sticky Trades University. You could start at the most basic level of option trading and work your way up to the intermediate level, the advanced level, and then plug into all my webinars, because my webinars, I spend hours each week talking to our members, showing them how to read the charts, showing them how to manage risk, showing them how to trade options and do it conservatively without stress. And if that's something that interests you, you don't have to sit in front of your computer all day looking at the market. You can place some of these trades, especially the option spread trades, go on your merry way, put some price alerts in, adjust your positions when needed, and have a life. I think that a lot of people are trying to hit these home runs over the fence with cheap trades, thinking, oh, I'm going to take my $1,000 and turn it into $1 million overnight. No, it's not about that. It's about chipping away at the market, hitting a lot of singles, and getting the runners to come around base, using the baseball analogy as just one example. So we love what we do here at Sticky Trades. I can guarantee you're going to enjoy your visit with us as a member. Stay tuned. Continue to like and share our videos. We really appreciate that. We're approaching 11,000 new subscribers. That's since July of last year. We have you all to thank, because if you weren't sharing on your social media pages, we wouldn't be growing like this. Thanks so much, folks. I'll talk to you in the next video. So long.